Trading is easy actually. If you are still confused about trading, you found a great video. I'm going to break down the trading strategy that professional traders use, simplified so much that anyone will have something to learn. Now, to keep things very simple to understand, we are going to use just two time frames. We are going to use a high time frame, can be any, let's say the 1 hour time frame, and we are going to be using also a lower time frame. Let's say the 5-minute time frame. The first step is high time frame trend analysis. So what we are trying to do here is to analyze what the price action has done in order to understand what it will probably do. So the easy question is the market in an uptrend? Is the market in a downtrend? So basically understanding in which market direction does it move. As we know, the price will not just go to the upside or to the downside in a straight line instantly over the long run. It can happen in the short term, but in the long term, the market needs a corrective move to balance out the liquidity. So that means that if price wants to go to the upside, it will go up, but then it needs to pull back down for a while, and then go to the upside even higher, breaking the last swing highs. Then again, small pullback to the downside, followed by another upside move that goes higher than the last move. So that's just how the markets move. That's basically the price action of an uptrend. It's plain and simple, as we have explained on most of my videos. The price action moves in waves and trends. So as we know in the uptrend, we have that price creating higher highs and higher lows, just like we have it indicated on this price action structure. So when price breaks through the last swing high, it creates what we call a bullish break of structure to the upside. And in uptrends, you will see these breaks of structures to the upside most of the times. What they show is strength of the buyers that lead to a continuation of the trend. But of course, the price does not go up forever, and we need to know that at some point, some selling strength needs to come into the markets. And that is the scenario when the price will move to the downside and break below the last swing higher low. When this break happens, this becomes a market structure shift. So this market structure shift pretty much just tells us that price is reversing from the initial trend. And the initial trend being an uptrend. The market structure shift tells us that the market has a high probability of reversing into a downtrend. And if price is turning into a downtrend, the price will be creating lower highs and lower lows, just like what we see on this price action structure. So for example, we see right here, you can see the lower highs and lower lows formation that is constantly repeating. And that repeated formation is what creates the downtrend or bearish market. Now the opposite of the bullish break of structure, here, the break to the downside into new lows are the bearish breaks of structure, which they are of course followed by a pullback to the upside, into break of the swing lows, which are the new lower lows. So again, a repeated bearish break of structure. And then eventually, price will return into a bullish uptrend price action again, because as we said, the market is moving between trends. This reversal again into an uptrend is caused because sellers are losing strength. At the same time, buyers are gaining momentum. And that is when we will get another market structure shift where price breaks above the last swing lower high, creating a new swing higher high. And now the market has validated a reversal from a downtrend back into the uptrend. So this is how the markets work. We got a price that swindles long term between up or down. Not complicated to understand. And that's the first thing we need to know really well. Basically being capable to identify if the market is bullish or if the market is bearish, because we look to trade with the trend. If price is bullish, ideally we look for buy long positions near these swing higher lows. And if price is bearish, we look for sell short positions near these swing lower highs. Now that's the simplest form of explaining. But we will find out that it's not really that easy to apply. And mostly because traders often find market analysis hard and confusing. But we are going to make sure you understand it well when we are jumping into the charts to backtest some trades. But before that, we need to master the basics. The basics are the building block of trading. And now the second question we want to ask, is the price following a continuation phase, or is the price following a pullback phase? That is very important to understand because, as we should know, after a break of structure is formed, we know that price needs to pull back to get more liquidity before eventually push towards continuation. This is where most people make the mistake of ignoring the break of structure. And these retail traders see that the market has broken up the last high, and they think it is bullish. And they are right. The market is bullish. But they place their buy positions right after the break without taking the pullback into mind. So what often happens for these retail trader is that the pullback actually stops them out from the trade, and then it goes back up into the take profit, but too late, because they've already been stopped out of the positions. This is one of the most frustrating things a trader can experience. So us, smart traders, instead of entering for a buy immediately, we want to wait for price to pull back, and then we will look for a buying setup opportunity around the lows. This makes our risk much lower than randomly entering when the price broke the highs. In other words, we are buying at a lower price. And our stop loss is also set with logic, being below the last swing lows. Why there? Because being in an uptrend, we don't expect swing lower lows to form right away. They will form eventually, but on reversals, not on trending movements. So to conclude the first step as a recap, we identify whether price is bullish or bearish, so that we know which side of the market we should be positioned. Then we identify if the price is in a continuation phase or a pullback phase. If price is in the continuation phase, we wait for price pullback and look for setups that follow the initial trend, basically trading with the trend. So now into the second step. The second step also has multiple steps inside of it. The first step implies being in the same high time frame as we were before, and we look to identify demand zones if the market is bullish, and identify supply zone if the market is bearish. Keep in mind, this is done on the high time frame, because these are the zones that are aligned with our higher time frame trend that we have analyzed before, and we want to be able to trade with the trend. So using this example, the price was going to the upside, and then it hit into a supply zone from the left side, which creates a pullback. As we know, the price rejects down supply zones. In this case, it did reject to the downside, forming the pullback, but then shortly after it went to the upside and broke the last swing high. The reasoning behind this is because supply zones do not respect breaking into new swing lows if the market is following an uptrend. So you can consider supply zones as liquidity traps on uptrends. However, the important structure on uptrends are the demand zones. So after the pullback formed from the false supply, the market usually continues the uptrend by also hitting a structure. That is often a demand zone, so the logic being that the pullback ends into a demand zone. Demand from which the price hits and moves towards the highs, breaking them, and having created a bullish break of structure. And considering that we have a continuation, the price action structure will probably look similar. So as we have said before, after a bullish break of structure, the price pulls back down. That pullback is caused because the market has hit a supply zone. However, in an uptrend, the supply zone is usually broken and not respected. So what happens is that the pullback ends on a demand zone, hitting the demand and moving to the upside towards new highs, which again create a bullish break of structure. And the price action repeats in the case of the market holding a continuation of the uptrend. But let's zoom into the pullback and see how we can use the pullback in our advantage. So this pullback is actually seen on a lower time frame inside the higher time frame. So if the first high time frame was the 1 hour, let's say the low time frame is the 5-minute time frame. And this is how a pullback would look like. So a pullback is just a low time frame downtrend. We can easily see how it forms lower high and lower lows. But it is important to know that this happens on the internal market structure. So as traders, we have multiple options. One option is identifying the high time frame demand. The high time frame, the demand is usually seen on the last swing high or low. But what if we have multiple demand zones available? The question becomes, from which demand will the price reverse to the upside? And honestly, I can't know. The price will move however it wants. So this is when risk to reward setups come into play. If we place a buy long order at the top of the demand, and we manage a decent risk to reward ratio, this being done on multiple demand zones, even if the ones from the above get stopped out, we lost only a small percentage. And if the second demand fills in and moves in to take profit, we recover all previous loss and still gain profits. And depending on your risk to reward setups, even more losses can be taken out by fewer winning setups and still end up profitable. Now some might ask, what if the price breaks down below the demand? Does that mean that the market has reversed into a downtrend? Well, not yet. Demand zones don't always hold and don't always work, because if that was the case, trading would be much easier. But know that trading is not really that easy. Sure, profitable and effective trading is simple to understand. It's mostly understanding how price action behaves, but that does not mean that every structure will always respect. The better you are at managing risk, the more it will be seen on your results. Now back to the question. The downtrend starts when the market breaks the past swing higher low, but on the high time frame, this causes an external bearish market structure shift into a likely downtrend scenario. Downtrend where instead of looking for demand zones to trade into, we look for supply zones. So it is exactly the opposite way around. So let's get into the next step. The third step is all about closely watching the low time frame price action. This is done in order to plan our trading setup. So we need to know two things here. The first thing is knowing if the high time frame trend follows an uptrend. And because we started the analysis from the high time frame, we checked the first step as valid. So we can see that the price action that approached the demand is a bearish price action. But this is just a low time frame downtrend inside a high time frame uptrend. And as you probably have heard multiple times, the higher time frame takes priority over the lower time frame. And this is when the second step comes in. We have multiple options for the setup. The first option is placing the buy long order on the high time frame demand zone. This allows a more swing type of trade. And the second option is to wait for the price to break the last internal lower high. This move is called a bullish internal market structure shift. And this basically indicates that the low time frame is aligning with the high time frame, both into uptrends in this case. Now this is where the second option for the setup comes. So after the internal market structure shift, we look for a demand zone on the low time frame. So keep in mind, the previous setup plan was taking the high time frame demand, and in this setup plan, we are taking a low time frame demand. Well, of course, if we can find one, because the market doesn't always form them, and all we look to do after is to wait for a pullback to the low time frame demand zone, demand from which we can take a buy long setup. Now this second setup is actually a higher quality one, meaning that it often has a lower risk and a potentially higher reward. So let's start with analyzing the macro external trend on the 4-hour time frame. So we chose the first high time frame as the 4-hour one. Externally, we got an upside push that sets a high, followed by a pullback to the downside, and finally, a continuation of the upside movement. So externally, this is a clear uptrend, with an external break of structure. Now, if the uptrend would continue, and that is what we are looking for, because we want to trade with the trend, and not against the trend. So by looking at a continuation, we expect a pullback to the downside. Pullback that ends higher than the previous pullback, and then a break of the recently made highs to keep a continuation of the uptrend. Now if we zoom in, slightly more on the internal market structure, we see the same alignment, which is a push towards highs forming higher highs, a pullback forming higher lows, and again a push towards new highs. So to understand what can probably happen next, we should first understand very well what happened recently. And recently the market held a continuation of an uptrend supported by multiple internal breaks of structure, and as well as external bullish breaks of structure as we have seen before. So I will quickly mark the most important ones recently. So what we look towards is a new swing break of structure to continue the external uptrend, trend that we can trade on lower time frames. So now let's zoom into the most recent price action. Here we look for points of interest, usually in form of demand zones. Demands because we have already confirmed that the market follows an uptrend, and on uptrends we validate demand zones. So we got one right here, which is the last candle before the upside impulse. We got another one above, and there is another one right here. So we got 3 demand zones. Now the question is, which one should we take? And as I said in the first minutes of the video, I wish I could be able to predict the market to such extent. The truth is that it's extremely hard to know from which demand zone the price will bounce up, but the good news is that we know that one demand zone has a high chance of respecting. It's actually very rare for 3 following demands to break down. So let's just test each of them. So let's hypothetically say we are risking 1% each position. That means that if we got stopped out, we lose 1%. So the first one, with a very high risk to reward ratio, that means that if we lose, we lost 1%, and if we win 6%. Now, unfortunately, this closes as a loss by that wick, so we lost 1% of the trading account. Now we are moving into the second demand, doing the same thing, buy long on the top of the demand, stop loss below the demand, take profit above the swing highs, basically looking for a bullish break of structure. This also has a similar risk to reward ratio, and this also closes as a loss. Well, now at least we have a high probability that the last demand could validate. That means that we can also look for a higher risk setup. So placing the order at the demand, stop loss below, take profit above the swing highs. Now we entered the position, but let's actually look to refine the setup by going into a lower time frame. So moving into the 15-minute time frame when the price touches the demand zone. If we look closely, we can identify a low time frame demand right here. So let's actually refine the entry by taking the position from this level and now moving back into the high time frame to adjust the setup. And we are looking for the same target, which is the swing high. And this is actually a crazy high risk to reward ratio. Normally, I don't take these types of trades often, but because this was the last demand available, I look for a higher risk to reward ratio. And finally, a great setup. So a 13.84 risk to reward ratio. So in the first two trades, we lost 1% in each. That's minus 2%. In the third trade, we won 13.84%. And the net gain is about 11.84%. This is the power of smart risk management. And you can see here why I often say market structure is super important. The market just continued to form a bullish break of structure. In uptrends, it's just what the market wants to do, to basically keep breaking highs. And we can take advantage of that by trading the pullbacks. Now we talked mostly about uptrends and demands. But then what happens if the market reverses into a downtrend? The question becomes, how can we also take advantage of trading downtrends? The same story applies just on the opposite way. We start from the first step, choosing a main high time frame as the first one. Then we ask, is this market bullish or bearish? Well, now we should be able to tell just by looking at swing levels. If the market is making lower highs and lower lows on the swing levels, well then this market is bearish on the high time frame. Then again, the second step, which is to understand what is the current phase of the market. If the market is in a continuation phase, after the break of structure, the market validates a supply zone. When the market enters a pullback phase, if it hits the supply zone, we move into the next step. The next step, which is broken down into multiple smaller steps. So we can just enter a sell short right at this supply zone on this time frame. However, if we want to refine a better risk to reward setup, we can zoom into a lower time frame when the price hits the supply. On the lower time frame, we look for a formation of bullish internal breaks of structure, which are reversed down into a bearish internal market structure shift. This shift reverses the trend into failing to break the last swing highs, and we closely look for a supply zone on the lower time frame near the swing highs, supply from which we can place a sell short position to take the price into lower lows. Now this is the riskier setup where we actually try to time the reversal from the first structure shift. There is also another option which is safer, and that is to wait for the first bearish break of structure after the structure shift, and we trade towards trend continuation. So right here, respecting the first step, which is to analyze the trend, and more specifically, the high time frame trend. At the beginning, we got a sort of end of downtrend movement, followed by a slow upside movement. This upside movement breaks the last swing highs, so we got a trend reversal externally. The first reverse break is the market structure shift from where the market holds a significant push to the upside. Basically, most candles closing bullish with barely any pullbacks. Now, as we know from before, on uptrends we buy long demand zones that are formed near downside pullbacks. For example, we got right here a demand zone that has worked out well, defined by the breakout that has followed after the structure shift. a pullback to the downside that has filled the demand zone, followed by a continuation of the external trend, basically making new swing highs. Well, that means a bullish break of structure. And the future of the price action, we already can see it shot up to the upside. So let's actually move into what happened next. Keep in mind, this is very important to analyze the whole picture of the market. So here it looks like we got a downtrend formation, and let's carefully mark each swing levels to make sure we don't get confused. Because swing levels are extremely important when it comes to trading market structure. So a repeated price action of lower highs and lower lows. Now here, pay attention. The market here had a small increasing upside move that ended up with a wick that takes out many of the recent lower highs. Now usually this is what we call a liquidity sweep, and not a valid break because the candle closed a bearish candle, and it couldn't keep up the bullish momentum. Now this is actually a pretty advanced concept, so let's assume we don't know that, and we assume it was a high formation internally. But anyway, it doesn't change much because the price keeps the continuation of the downside movement afterwards, and broke out the last swing lower low, this candle, by closing below the level. So this is a valid break, therefore a bearish break of structure in this case. Now let's see the continuation. On the continuation, we can see that the market is actually coming back into an uptrend market structure. The first upside break is very important, because this is an internal market structure shift towards the bullish side. This is basically the level from where the price started this whole new upside movement. That has its swing levels that respects the uptrend formation of higher highs and higher lows. So we make sure to mark the swing levels once again. Pullback to the downside, which has its higher low. Break towards new highs, so a bullish break of structure. Pullback again to the downside from the new high formed, then break of the new highs. Basically the same bullish price action that is repeated constantly, so I will quickly mark the swing levels. So now let's just move into the most recent price action. Look here. At this break, the market broke up with a wick again and could not close above. So after the past higher high and the pullback that formed the higher low, the upcoming push could not create a valid higher high that would continue the uptrend structure. But instead, it started to moving into a new downside movement. Now this first break is also very important. As we have said before, the first break of the internal higher low in an uptrend is an internal bearish market structure shift. And now look closely on the swing formations that I will quickly mark. So we got lower highs and lower lows. But let's zoom out to understand the external structure. After this, you will understand it much better. So if you actually look externally, we got a push to the upside, followed by a pullback and a break of the last swing high externally. So an external bullish break of structure. If the market would continue to the uptrend, the price action would be creating new external swing higher highs. But in this case, the market pulled back down. But the problem here is not the pullback itself. The problem for bullish traders is that the market has broken down below the last external swing low levels, which has created an external market structure shift towards the bearish side. Now the most likely scenario is for the market to continue its trend, which is a downtrend because we got the swing lows broken, and a downtrend is characterized by forming external lower highs and external lower lows. So now zooming to the most recent price action, we see here a downturn of the price, and of course making sure to understand the swing levels, which in this case are lower highs and lower lows. Now being in a downtrend both internally and externally, we look for the market to continue its trend, followed by formations of lower highs and lower lows, and on these formations, we look for supply zones. The trader's goal is to wait for the market to fill the supply and follow the move with a sell short towards new swing lows, to basically form bearish breaks of structures. And in this price action, this translates into identifying the supply, which is the last candle before the impulse of the downside movement. And now that the price has filled the supply, we move into a lower time frame. Let's say the 30-minute time frame. Keep in mind, it's not a fixed time frame that we need to move into. It's best to not move very far away from the initial time frame. So the 30-minute is just fine in this case. And if we do a quick analysis on this one also, it's easy to observe the uptrend structure with its bullish breaks of structure. So this follows an uptrend internally, but the price has hit the supply. So if the price breaks below this swing, this shows an interest of traders to align the internal uptrend into an internal downtrend that follows along with the high time frame trend, which is to the downside. Shortly after, the market kept approaching the last highs. It's also important to keep in mind the swing levels from before, and if we pay attention, the market failed to break above the last highs, which formed new lower highs. Now the only confirmation we would need is a break of the lows to form lower lows. So basically to form a downtrend price action, which is aligned with the high time frame trend. And we got the break, and is followed by a pullback to the upside. But the important move here was the break, because the first break of the last higher low in an uptrend is a market structure shift towards the downtrend, and because this is done on the lower time frame, it's an internal shift. So basically, our expectations of a downtrend internally is to hold a continuation of a lower highs and lower lows, all the way down to the external lows on the high time frame. So this is where we have refined our setup, and we basically do exactly like we did before. On downtrends, we look for supply zones. The supply zone is the last candle before the impulsive push to the downside, which is this zone. And the setup positioning you probably already know. Sell short on the supply, stop loss above the recently made supply, and take profit. We can place it below the last internal lows, but as we can see, the risk to reward is pretty low. Other options is to look for the take profit below the external lows on the high time frame. This gives a great risk to reward. It's the most I would have taken. I honestly don't like setups with way too high ratios. And the logic behind is to follow the high time frame trend into creating a break of structure externally. Level where we look to take profit, because as we said in the first minutes of the video, after a break of structure often comes a pullback, so we are looking to take profit at the lowest price we can get. We discussed about the technical side of trading, which as you've seen, it's not complicated. However, it's crucial to understand that without a proper psychology control and discipline, learning technicals becomes pointless. On the link in the description, I've built an ebook on how to stop destructive trading behaviors, and as well as more complex trading guides. If you liked the video, leave a like and feedback in the comments. Have a great trading session.